Ladies and gentlemen, welcome back to yet another episode of Crypto Over Coffee. I hope you're doing well today, and if you're new here, every single Friday I break down the latest news and the hottest topics in the world of technology and cryptocurrency whilst drinking a cup of delicious coffee. Now in today's episode we're talking about Ethereum 2.0, Ethereum's secret weapon of sorts, Bitcoin's price, and of course our usual 404 logic not found segment. But before we get into all of that, like usual, we're going to answer some questions that I've gotten on YouTube and Twitter. So I'm going to pull those up now on the computer. And of course, if you want one of yours answered, you can tweet me at Hashoshi4 or just leave it in the comments below. And if you would be so inclined, please do hit that subscribe button and hit the bell notification button so you can get a heads up whenever I post new content here on the channel. Thank you in advance. Now, the first question is from Andre on Twitter. He said, I would like to hear your thoughts on Xio, X-I-O. I would assume that that's what it is pronounced as. So this is within 5 minutes of looking at the website for the very first time. So this is not an endorsement. This is not me saying go buy something related to Xio. But I think it's a very interesting concept. Basically, it's almost like implementing flash loans for staking, where you can stake your cryptocurrency for a network of choice. You get all the proceeds up front within basically a matter of seconds, and you lock up your stake. So you're basically getting a cash advance on your stake rewards. So I think it's very interesting. This is a DeFi product, and I think the way that they describe it here, looking at the website, they're almost like the Uniswap of staking, right? So that's like flash staking. So pretty interesting stuff. I'll have to do more research on it, but first thought is I'm definitely going to be keeping an eye on this project, and thank you for bringing it to my attention. Awesome. Next question is from Eduardo Lopez. Do you buy crypto more for investing or because of the idea that crypto will be common in the future and that you're getting in early? Do you invest in other assets? Great vids. So I think it's a little bit of both. I invest as an investment because I think crypto is going to be more and more ubiquitous over time. There are projects, because I'm a fundamentals person, I'm a tech person, I'm not a trader. I don't look at the charts. I look at, is this tech going to change the way that we do business and the way we interact with each other? Is this creating a new business model? Is it technically viable? That's what I'm really looking at. And I look at whether or not a crypto project is solving a real life problem. And so if it is, I invest because I think that, heck, I'm getting in early on something that's going to solve a real problem. And if it fails, it fails. And I'm happy that I invested in something I thought was good. And do I invest in other assets? Yes, I like to invest. And again, I invest fundamentally based on what I think is valuable. So companies, I invest in companies that I think are valuable and useful and present solid solutions to real life problems. And then I also do invest in precious metals. And I used to actually flip cars and guitars, actually, two things that I really like, outside of crypto. But I don't do that anymore because I just don't have time and patience to deal with it anymore. So yeah, I do invest in other things. Thank you for that question. Have a good one. Let's see. Alo Ariza Madrigal asks, thanks a lot like always. Thank you for watching. One question. Right now, I believe Unstoppable Domains works on Ethereum. Yes. With Cardano, Elrond, and all these competitors, can we expect to see some version of domains on their mainnet? If so, Unstoppable Domains already won the .crypto domain. In general, how's the future of blockchain domains going to look? Yeah, so I think you brought up a great point. Ethereum currently hosts the .crypto domains. Ethereum also hosts .eth, the ENS domains. And then Zilliqa has .zil. I would assume that most networks will have some sort of blockchain-based domain that they use, right? I would assume also that they'll take just the a standard ending, like Cardano might have .ada or .card or something like that. Same with Elrond. I have a feeling that we'll see Unstoppable Domains moving to other networks. There's no confirmation from them about that. I'm just postulating. But I also think that there will be projects that implement blockchain-based domains on all of these different new projects and new mainnets. There are also projects who have started kind of building that into the core framework of their protocol, which I think is also a very interesting point as well, is to allow for human readable names natively in a protocol, not just using a smart contract on top of a protocol. That would be what I think the future of blockchain-based domains is. It's actually going to be woven into the fabric of the protocol itself, and not just a service on top. So the future of blockchain domains is one that's very free and fluid because there's no central authority just deciding how it's being built. But I think blockchain-based domains are going to be the crux of a lot of services in the future because it's mapped to your key and you can only control your domain with your key, but it's like sort of a layer of abstraction on top of that really kind of complicated thing that people don't get. So I think that's where the future is. Thank you for your question. Randy Olson, potential question regarding Cardano. Fantastic. Is it better to stake your entire bag with one stake pool now that Shelly is out, or perhaps to create several wallets on Daedalus in order to diversify an entire holding across many stake pools? Advantages, disadvantages. So this is a great question, and I think my buddy Pritesh, who runs the channel Kaizen Crypto, is probably a better person to answer that because he actually specializes in stake pools. He runs his own stake pool. And I think this is going to be a fantastic question for him to answer. So I'm going to leave that to him. Let me phone a friend real quick. So check this out.
Hey Hashoshi, thanks so much, man. So Randy, that's a great question. That is a fully loaded question. I'm going to do my best to answer that for you. I like to think about it kind of like two sides of the coin, or maybe like a double-edged sword. So I guess let's start with what are the advantages of delegating to a single stake pool. So I guess the biggest thing to look for is going to be making sure that the stake pool has a good performance. Whenever the stake pool is assigned a block to mint, if the stake pool is online and if they're able to mint that block, making sure that performance is high. You also want to make sure that the amount of live stake delegated to the pool is actually high enough that they can actually receive blocks so that they can actually get that high performance. Another thing would be making sure you're paying attention to the margins. So as far as their fees, making sure that the stake pool is able to remain profitable so that it can maintain its operation, but still being able to reward its delegators as much as possible. So that would be one of the advantages of delegating your entire holdings to a single stake pool. You're able to maximize your rewards if that stake pool is performing optimally. Maybe the disadvantage of that would be, let's say for instance, you pick a stake pool and maybe the performance isn't so great. Well, in that instance, you're definitely going to see those rewards that you would have potentially earned had you picked a different pool be considerably less. So that's one thing I like to consider as far as choosing a stake pool, making sure the performance is as good as possible, making sure there is a decent amount of live stake delegated to the pool so that you can actually mint blocks, and making sure that the fees are nice so that the delegators can be rewarded as much as possible. And let's go ahead and talk about the next part of that question. So as far as the advantages of delegating to multiple stake pools, this is something that I would recommend if you are starting out with delegating and you want to get familiar with what you can potentially expect with rewards. Of course, not financial advice, just a suggestion. And I'm talking about some of the things that I've personally experienced by being involved with Cardano. So as far as the advantages of delegating to multiple stake pools, let's say for instance you have that experience where your ADA is spread across multiple pools, you are actually going to be able to mitigate that risk should one of those stake pools have a lower performance. So that's going to be the advantage of having it spread across multiple pools. And then again, the drawback to something like that is probably, let's say had you had chosen a pool that had a really good performance, you're not going to see as high a return because you've had those bags and those holdings spread across multiple stake pools. So take it for what you will. I can't tell you what to do with your money, of course, but I can tell you what I'm doing with my money personally. So for me, what I like to look for are stake pool operators that are contributing to the community, who I really support, because that's really what you're investing in at the end of the day. You're investing in the maintenance of the Cardano network, and Cardano is built on a community that is completely decentralized now that we see Shelly. So it's really incredible to see all of the great work and collaboration from all the members in the community. So I like to make sure I'm supporting all the people that I believe in and that I trust, and making sure that I help support them as much as possible. So I hope that answered your question. I know it's quite a long-winded answer there, but anyway, thank you so much. Hashoshi, back to you, man.
All right, so welcome back. Thank you very much to Pritesh for answering that question. And if you haven't already, please do head over to his channel. I'll link it in the description below. He makes a lot of great Cardano content, technical content. and also stuff about stake pools, so you can start earning some passive income using Cardano's ADA. So that's fantastic. And thank you very much again, Pritesh, and to you for watching. Cool. So let's take a look. All right. Bebo Snipes, big fan of your YouTube channel. Quick question. For some reason, can't find a clear answer on the web. Does staking consume compute resources just like mining? So the answer is yes. Staking does consume compute resources, but the answer is no, it's not like mining. So compute resources have to be used, obviously, to run a node. So when you're staking or you're participating in a network, there's going to be some compute resources being used to make calculations, to calculate hashes, to sign transactions, but the energy required is so much less. And so one of the main reasons why people move to proof of stake is partially because of that huge energy savings that you get and cost savings that you get. So in mining using proof of work, the main lever or the main disincentive mechanism for people to do the wrong thing is really the sheer cost, right? The cost of the energy it takes to calculate proof of work. And that's what gives you that Sybil attack resistance. That's what protects the network. But instead, in proof of stake, instead of doing that every consensus cycle, you take some sort of fixed cost that someone already has, and that is stake, right? You have them either lock up or put at stake their wealth in the network. So there's cost there, but it's not replicated every round of consensus, right? Because they already have those assets. You reward people for doing the right thing and you slash for doing the wrong thing. Slashing means you lose your stake. And so that's the punishment. So there are calculations done for that. So proof of stake does still take energy and still does take compute resources, but compute resources are not the main cost lever to set up that disincentive incentive cycle that you need for successful consensus. So hopefully that makes sense and that answers your question a little more clearly. Thank you very much for your question. And then the final question of the day is from Nickname. Would BTC break in a world with quantum computing, a world where quantum computing lives up to its theoretical results? The answer is markedly yes. But what is the misnomer is that I think online, especially in this community, people are like, oh, Bitcoin's going to break. Okay, yeah, Bitcoin will break, but so will a large majority of everything that runs on the web today. If quantum computing reaches its theoretical results where we are now, and we're using the same cryptography standards and the same bit depth that we have today, virtually all of the internet is screwed. That's just the truth. And so the reason for that is because even things like TLS or SSL, like so HTTPS traffic that you use online uses asymmetric keys. You have a public key certificate that's signed by a private key. At that point, if you have this, given the public cert, an attacker could use a quantum computer to factor the prime that is going into that public key and derive the private key from the public key cert. It would break the entire internet. So the same thing applies to Bitcoin. It uses an elliptic curve to do signing. So you have your public and private key pair. Those are elliptic curve keys, SECP 256K1 keys specifically. And ultimately what that means is that given your public key, someone could derive your private key. So it breaks the entire signing mechanism behind Bitcoin and many other cryptocurrencies. So what basically we need to do is to develop cryptography standards that are resistant to and not dependent on methods that quantum computers can break. And so prime factorization is the one. Shor's algorithm, we're going to have to develop Shor's algorithm proof cryptography. But hashing, on the other hand, which is one-way function, can only really be broken using brute force. And so even with quantum computing, that will still be very difficult. So you're not going to have this issue of having someone use a quantum computer to just destroy the entire backwards compatibility of the network using hashing. So I don't think we have to worry about that. The real danger is asymmetric cryptography being broken in its current state. So hopefully that answers your question. Thank you very much, Nickname. Now let's dive into the news. Now, right up front, let's talk about the increasingly pertinent issue of scams in the crypto space. Now, we've moved into what many are calling another bull market cycle, and there's been a crazy uptick, in my opinion, of scams that are utilizing all sorts of different methods of taking your precious crypto away from you, and that includes impersonation of people like me on Instagram, Telegram, email, and other social. So just to lay this out there, if you get an email from someone claiming to be me that's not using the @Hashoshi domain, it is not me. If you get a DM from someone on Telegram or Instagram or Twitter that's not @Hashoshi4, the number 4 at the end, no underscores or anything, it's not me. And please report them. This is the same case for many of the peers that are here on YouTube and on social media. There are lots of people trying to sell mining scams, arbitrage scams, or just trying to get you to send them crypto. So please don't do this and keep your wits about you. So none of us are ever going to ask you for crypto at all. And there's also a huge increase in malware being distributed right now online, which will pose as a wallet application or a companion app for a hardware wallet or a website that's going to give you free crypto, and they ask you for your seed phrase. Remember, never enter your seed phrase on any device or any app except for your hardware wallet or the official application on your mobile device, like on your Apple device, that is for your actual mobile wallet. So none of these apps will ever ask you for your seed unless they're scamming you. So please do keep your wits about you and be safe. And speaking of safety, there was news this week of yet another problem for Ledger, the French hardware wallet manufacturer, where a vulnerability was discovered in the applications that serve Bitcoin and its derivatives on hardware wallet devices. Essentially, this vulnerability would let an attacker trick you into signing a transaction that sends Bitcoin to the attacker's address of choice by disguising that another transaction as a Bitcoin network transaction. So it would take a Bitcoin-derived network like Dogecoin, populate a transaction that you thought was for Dogecoin, and actually sign a Bitcoin one instead. So this is essentially a spoofing attack where the transaction one is approving on their Ledger device through the companion software is in fact pointing at the derivation path for Bitcoin and not for the coin it's showing you. So this particular vulnerability is not one that exposes a user's private key or that undermines the storage of the key on the device, but it's one that tricks you into using the device to do the hacker's bidding on your own, which is kind of like a social engineering attack in many ways. Now, since the disclosure of this vulnerability by a researcher in the Bug Bounty program, Ledger has added a fix to their Bitcoin apps which will warn you, a user, if the derivation path differs from the expected path for a given transaction. So you can always see and decide if it's valid or not. Now, note, if you're using an external third-party wallet, this will always pop up, so it's not great. Now, this is not elegant, but it works okay up front. But the issue is this. A, Ledger was still reeling from its marketing database breach, so they were a little late to disclose this issue. And B, the fix that they shipped in this case is only a temp solution, in my opinion. The core problem at hand is that the derivation path restrictions evident for other cryptocurrencies just aren't there. And that's not just on Ledger, but on many other wallets that will use this same standard. So for now, don't stress out too much if you have a Ledger device. Just be mindful, update your Bitcoin app, and stay away and aware of transactions that pop up and say the derivation path is wrong. So just be mindful. Now, in regards to Ethereum 2.0, the latest Medalla testnet is chugging along quite nicely with over 20,000 validators running on the network in the public domain and over 650,000 Ether staked. So it's looking like we finally have a beacon chain and proof of stake release candidate that is ready to rock. Now, I get a ton of questions about things like, what is ETH 2.0? When is ETH 2.0 coming? What's taking so long? Why is this happening? So I'm just going to take all those questions and try and answer them here. So first of all, what is ETH 2.0? In short, Ethereum 2.0 is a brand new blockchain protocol. It's going to be built to replace the Ethereum 1.0 chain that we have today that uses proof of work. So this is not a hard fork. And you might have been misled to believe it's a hard fork, but it's not. It's a new blockchain altogether. This means that Ethereum 2.0, at least early on, is going to run in parallel with the current Ethereum network we have today. This is for two reasons. One, because dApps that currently operate and serve thousands of people and make lots of money need to continue to work without downtime while Ethereum 2.0 is built. And two, many of the core components of Ethereum 2.0 are not yet ready to go in this first phase. And so speaking of phases, Ethereum's launch of the 2.0 network is starting with phase 0, the one that we're kind of in now, which will bring the core proof of stake consensus mechanism that they've worked on and the main beacon chain to the mainnet. So it's like the first step. This means that for the time being, once phase 0 launches, probably in the early fall, the only thing it's really going to be useful for is facilitating proof of stake consensus, improving that out, and allowing users to stake or run validator nodes on the network to get rewards. That's basically it. There's not going to be any real functionality or capability beyond that point for phase 0. But then after that, phase 1 will bring sharding, which will allow for up to 64 mini proof of stake chains to operate independently to validate transactions, which will be orchestrated like a puppeteer by the main beacon chain that we just talked about. So this basically means that you're going to get parallel execution of transactions for greater scalability. Then in phase 2, the real meat of the network is going to get released, which will bring things like cross-shard transactions and contract execution, the new decentralized application execution environment built with WebAssembly and other tech like it, and the rest of the core functionality required to bring ETH 2.0 to full parity in terms of functionality with what we have today. Of course, to a much greater degree of scalability and probably security. This will not be fully realized, in my opinion, until 2022, being realistic. That's just a fact, and I actually think I'm being optimistic there. You won't see dApps fully running on Ethereum 2.0 until 2022. That's my prediction, and I think, again, I'm being optimistic with that. So this means that, in the meantime, layer 2 technologies like Matic will likely be critical for the current Ethereum network to continue to operate. And that said, the next question I get is, why the hell is this taking so long? And here's the truth. Ethereum has the hardest job in crypto today. They have to re-architect their entire network topography and architecture to be more scalable and usable, but they also have to make sure it's backwards compatible and just as secure, if not more secure, than its proof of work current state, so that all the users and developers and dApps that already exist today will work flawlessly when Ethereum 2.0 comes out. So that's a really, 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 really large and challenging job to complete. Not to mention the normal challenges of building a provably secure proof of stake network, which can take years in and of itself. So Algorand, Cardano, etc., all took years to develop this kind of functionality. It's not easy, and I'm sure their teams can attest to that. But they also had the advantage of not having to start from one place. They were able to start from scratch without being tied to backwards compatibility or decisions that they made 5 years ago or 7 years ago. Now, I'm a developer. I build dApps and traditional applications too, and I am a plebeian compared to the protocol developers who are building these things. Like, these guys are really smart. These girls are really smart. This is not easy stuff, and I can't overstate that. So that's precisely why this is taking so long. And they have one shot, only one shot to get this right. If this breaks, when it comes out, no one's going to use it. So it takes careful planning and development. And what this means is that the new Ethereum 2.0 network is probably going to be duking it out with Cardano, Zilliqa, Algorand, Elrond, and others in the coming years for that precious market share of dApp users and developers. And it'll be a battle to watch intently because it's going to be a hell of a battle. Now, I think there will be multiple winners that each settle into distinct niches where they fit best. And of course, the other question people ask is if I think Ethereum is cooked or done for because of how long this is taking. And my answer is this. Ethereum's greatest weakness is also its greatest strength. They have the most users, they have the most developer tooling, the largest developer community, lots of funding, and lots of dApps that already run on the network. This makes it a lot harder to develop a new protocol that works, but it also means the path towards adoption of that new protocol when it comes is much faster. So that's why I say while Ethereum 2.0 might take this long to get there to the protocol level, it's only going to take them like this long to get new users, where it might take a lot longer for these new protocols to get their users and get their dApps built. So Ethereum won't be chasing users and developers and dApps the same way that the others will. So these are things that people need to think about when you're discussing protocols and thinking about how much adoption they're going to get and how successful they'll be, because it's really important, but maybe not at that surface level of, oh, my stuff's in mainnet, you know? So one thing that comes up quite often is this comparison, though, between Bitcoin and Ethereum. Which one is better? Both sides of these equations start accusing the other of doing this or that, or claiming one is better than the other. And I just don't get it. The two networks are so different, so incomparable, in fact, that they're dependent on each other, but totally different. Bitcoin is the gateway for Ethereum. Ethereum is a gateway for Bitcoin. And after the word blockchain, there's basically nothing shared between the two in terms of their value prop, their use case, and their composure. Now, for example, Bitcoin's major draw is that it's a non-replicable, non-centrally controlled fixed supply asset. You can easily verify using cryptography the ownership of assets and verify the supply at any time. Ethereum is categorically not structured that way. The supply is large, the token economy is different, and the purpose of the coin is not even close to the same. Ether itself is arguably a utility token to just pay one's way in a world computer. So there's nearly nothing that can be compared apples to apples here. So this whole maximalist dueling between the two is really only an extension of insecurity on both sides, and it does nothing to contribute to solutions to the world's problems. Which brings me to today's 404 Logic Not Found. And for those of you who are not familiar, I highlight in this segment notable tech-related fails or otherwise stupid things in the world that need to get some attention. So if you want to help this video get some attention, please do hit that like button and get subscribed to the channel. It tells the YouTube robots that you're enjoying the content and that other people should watch it. So thanks very much in advance for that. But today's topic is one that you might personally have some familiarity with and have experienced yourself. So let's dive right into that, shall we? And that topic is actually toxic maximalism in crypto. Now, there's one person that I think we should mention in particular who exudes the very arrogant, myopic, and condescending behavior that, in my opinion, weakens this entire industry. And that person is Adam Back. Adam Back is probably best known for his early involvement in Bitcoin's history and his work in the open source community on Hashcash proof of work, for example, and more recently for his work on layer 2 solutions and adjunct Bitcoin tech at Blockstream. Now think things like Liquid and Lightning Network that he's been working on. Way back like 9 or 10 years ago, when I first read about Bitcoin and started digging into the community and who's behind it, I read about Adam Back and he was like this legend that I looked up to. But as I guess the case is in life, you grow to realize that not everyone is as they see him on the surface, and your own beliefs start to diverge from these sort of legendary figures. So if you scroll through Adam Back's Twitter, you'll likely find countless examples of his unabashed disdain and hateful rhetoric towards virtually anything that's not Bitcoin core. And recently, Adam Back has continued that trend. But let me sum it up for you based on my understanding of the tone of these tweets. The entire attitude is that Adam and his Bitcoin cohorts, especially at Blockstream, are smarter than everyone else. If you like anything but Bitcoin, you don't get it and you're being scammed. And then B, everything but Bitcoin is a shitcoin with no value and it's just a total scam. Those are the things that I glean from these types of tweets, but feel free to weigh in yourself if you think I'm just totally off base. I mean, in this particular exchange here, I'll show it on the screen, Back pretty much called out project founders for Ethereum, EOS, and etc. as Ponzi scheme scammers and likened them to Bernie Madoff, obviously a criminal. I don't even have to address that, to be quite honest with you, it just makes no sense. But one thing to note is that at least Ethereum's community admits readily that the network isn't perfect and are working to overhaul the tech that clearly doesn't serve the needs of its users. Bitcoin, well, that's another story, to be quite honest. People are trying to build technologies that serve different use cases and niches than Bitcoin, and that doesn't mean that they're scammers or that these things aren't useful. My genuine opinion is that maximalism is not only a sign of significant insecurity and arrogance, but it's also a serious threat to the entire crypto industry at large. When you get arrogant and you get comfortable with where you are, you get left behind. Here's my view. Bitcoin is arguably among the more important inventions of the century, maybe even more. It's the first truly cryptographically non-replicable digital asset built on sound economics. That's true. It's an excellent store of value long term. It's a significant portion of my net worth, no doubt. But that being said, Bitcoin can't do everything. Bitcoin is not everything. Bitcoin cannot and will not serve every use case and value-driven activity on Earth, and that's just a fact. So that leaves room for other honest, high-integrity projects to come in with tech solutions that they think have merit, and many that will take the core tenets of Bitcoin to heart in building these solutions. So, I mean, Adam Back's work with Blockstream, a company which is reportedly predicated almost exclusively on Bitcoin's success, seems to imply a potential conflict of interest, especially in terms of his commentary on projects that are not Bitcoin. And look, I have no problem with someone who believes that Bitcoin is the only thing that's valuable to them, or someone who doesn't see value in crypto really at all. But I do have a problem with people who spout opinions as fact and refuse to give any credence to anyone else's opinions as their own projects and beliefs are the only thing that they can really believe in and trust. The reality is that Bitcoin and other projects in the space that are deemed shitcoins by back and others who share his beliefs have a symbiotic relationship with Bitcoin. Without these so-called shitcoins, we would have far fewer people in this industry. We'd have far less money invested in this industry at large. We'd have far fewer valuable projects or products being built with blockchain technologies. And to be frank, less diversity of thought in this space would probably cause it to implode. Specifically in regards to projects like Ethereum, which for all intents and purposes should be a wonderful open source partner for Bitcoin's community, both supporting functionality that the other does not provide, is often now just devolving into a petty retirement home boxing match. Tweets exchanged between both parties, and both parties on Ethereum and Bitcoin's side, both just coming out losers. Now, if I could lend some advice, I would ask that Back and his Blockstream team, and really anyone else in this space that deals with this maximalist identity, works on making their technology better, making their technology more valuable to its users, rather than trying to tear down other projects in the space. So 404, logic not found. Now, related to that topic, I would like to leave you with this in regards to maximalism. Anyone trying to build something valuable in the space, even if it's a failure, is more useful than sitting here operating under the delusion that we've already solved all the problems related to this stuff. To be honest with you, everyone who's building something that they believe in should be encouraged to do so we can learn from it. Now, in terms of Bitcoin's price, which I think everyone wants to hear about, we're still sitting nicely above 10K, and we've had some volatility at times, but overall things have been in the $10,000 to $11,500 range for most of the week, to be quite honest with you. And I have to tell you, I'm kind of surprised, to be honest with you, that there's so much stability at these levels, because I thought we'd have some issues with panic sell-offs after a whale sold off a big heap of Bitcoin the other day, which of course did happen, but the market somehow stayed relatively calm by Bitcoin standards. Many people are claiming now that we're in the start of a new bull cycle, which I guess is possible, but I'm not really convinced of that quite yet. I think we're still teetering on the edge of upside or downside depending on what happens in the world around us. I mean, who knows what the next wave of stimulus and inflation could do to prices of the markets, across the board. Theoretically, people imagine that this inflation that's totally off the chain right now bodes well for Bitcoin, and on principle it does, but in the short term it might not manifest that way, and I would ask you, what do you think about it? What I think is that there's an opportunity now with retail investors because younger people are flocking towards investment in light of all the stuff that's going on in the world today, and it's a great chance to get new investors into the mix. That said, it's critical that we, the folks that know this space and understand it and have been here for a long time, help these new people do things right, help people avoid the mistakes, help people check the boxes on best practices. So if you have some things that you think new users should know, please leave them down in the comments below, because I'm going to compile these into a list and maybe create like a video about how to get started. Now, I did want to make some time for a new segment on the show because pretty often people send me products to try out, and since the show is about tech, money, and stuff like that, I decided that out of the dozens of things that I get sent, I'll pick out one a week that I think is actually cool that I'll actually use and share it with you. So for transparency, these are not paid reviews. I choose what I show and I give my candid feedback, no script, but the products are more often than not sent to me for free. So I'm not getting paid and told what to say, but I am getting the stuff for free. So take that for what it is. That being said, this week I wanted to show off something called the Ekster Parliament Slim Wallet. So this is basically a minimalist wallet that you can carry around. I carry around my Crypto.com card in here and my ID and all this sort of stuff, and it's RFID blocking, so it's got this aluminum shell, and so it's got this little like quick draw trigger, and so you flips your cards out. Pretty fantastic stuff. I love this wallet, but the tech part of this is actually a tracker card. So while the wallet is perfect for what I like, it's super small, light, it's RFID blocking to stop people from scanning my cards because I'm a kind of a freak about cybersecurity type stuff like that. You can also get this tracking card from a company called Chipolo. If you frequently lose your wallet or you can't find your stuff, this is really useful that you can strap to this wallet. And this card connects to your smartphone using Bluetooth Low Energy. And it allows you to track your wallet down using GPS pins. And you can also get notified when you leave this geofenced area where your phone can no longer communicate with this card. Now, I've basically hated all tracking products because they collect way too much information, they require a user account, they have garbage privacy policies, and everything's a black box. And however, while this is not perfect by any stretch, this Chipolo card allows you to set up a connection with your phone without giving them one piece of personal data. I didn't give them my name, I didn't give them my email, I didn't give them anything. I created an account using Apple's private relay feature within the app, which is like a proxy, if you will. So the weak link is that your phone obviously has an IP address, which could theoretically tie back to my location. But if you own a cell phone, you're already subject to that risk of getting your location taken anyways. So Chipolo seems to have made a good faith effort to protect privacy, but it's a GPS card at the end of the day, and it's not going to be 100% private. The card, though, can also be used as a remote trigger for your phone camera. It can ring your phone backwards to locate it. So if you lose your phone in your house, you can hold this card button down twice. It'll ring your phone, which is pretty useful. And of course, it's a personal choice whether you'd ever use something like this and if you trust the process. But I love that they've made every effort to make this as private as possible by taking your user account out of the mix and making it Bluetooth based. So I'll link up Ekster stuff down below. I think this is a pretty cool piece of tech, and I'm definitely going to use the wallet. So if you want to check out any of their other products, you can do that down below. Now, guys, thank you so much for watching this video, but if you have some time to stick around, I do have a brand new altcoin picks video where I talk about some low caps that I think are just really, really impactful projects. So if you want to check that out, I'll leave it up here on the screen for you to watch. But as always, thanks so much for watching this video. I hope you have a fantastic weekend, and I'll catch you on the next one, guys. Cheers.